Well, welcome into another daily editorial here on the KE Report. In this daily editorial, I am joined by Jordan Roy-Byrne, the founder and editor of the Daily Gold. Jordan has a great website for all of those who are focused on the metals, who want to both know fundamentals and technicals. Jordan's a fantastic chartist, and I know that because him and Doc have chatted at length a number of times, and both very often see eye to eye, which gives me a lot of confidence for what Jordan has to say. That being said, Jordan, what we're going to talk about here is initially your general view on the metals as they are breaking down and getting into an oversold territory. It's important to note that they're not in an extreme oversold level, but man, after that sell-off yesterday across the board in the metals complex, it definitely gave the precious metals bulls a bit of a pause for any of their arguments that, hey, you know what, gold is going to maybe break 1,300 by the end of the year. Yesterday was rough, and quite frankly, let's get your general view. What's your take on the conditions right now for the metals?
Yeah, unfortunately, Corey, the conditions are just bearish. I mean, whether you look at the charts or you look at the fundamentals, they're unfortunately bearish. Now, gold has not broken below 1260 yet, but I would expect that to happen based on the activity in the entire complex outside of gold. I mean, silver has broke down. The mining stocks obviously have broken down. If you look at gold against foreign currencies, that's also broken down. I mean, that's been having a negative divergence the last couple months. And if you look at I know we're going to get into some of the fundamentals, but if you look at nominal yields, they've just been surging, particularly short-term yields. So that's not positive for precious metals unless inflation or longer-term yields are rising much faster than those short-term yields. So, I mean, that's really been the fundamental explanation for this weakness. And another issue is the dollar has just done nothing. So I know that some people have been hoping that, well, the dollar is really weak and the dollar's going to roll over and that's going to help precious metals. I mean, you could be right in that scenario, but gold is just, it's really not been a good year considering how weak the dollar has been. I mean, it's been really weak, and gold has not been able to make a new high this year. The miners didn't even come close, even though the dollar made a new low this year. So that's always a negative when the dollar is that weak and you see precious metals just cracking and breaking down. I mean, that's just not a good sign. We are breaking down. We are getting oversold. I don't think it's time to jump in yet, but we'll see. Maybe before the first Fed hike, we'll probably get some kind of temporary low and rally in January. But yeah, here and now, Corey, unfortunately, things look negative, and I think it's going to take some time before this negative period runs its course.
Okay, let's focus on the yield environment because, as you said, we are seeing short-term yields continue to move up. Even long-term yields are moving up, but again, we are getting a tightening of the overall yield curve, and this is all in the face of real interest rates, again, with the Fed continuing to increase the short end. We are in, well, another positive real interest rate environment, which, again, hurts the precious metals. But again, in terms of this flattening yield curve and shorter-term yields breaking out, even look at the 5-year yield, this, again, is a pause for concern for you, isn't it, Jordan?
Yeah, it is, because when you're looking at yields, it's really a steepening curve, which is bullish for precious metals, because a steepening curve usually indicates a rise in inflation expectations or a real caution, a caution on the part of investors where they're really cautious, and you can get the other way you get a steepening yield curve aside from rising inflation is when the short end is going down faster than the long end. And so we had that a couple times in the last decade. When the economy's rolling over, you're concerned about financial conditions, you're concerned about the health of the financial system. And so that's what would cause a steepening curve, and a flattening curve, which we've been getting, which is basically the yield curve going down, but it's still not going below 1.0. If you get below 1, that would mean inversion. The 10 and 2 year, the yield curve there yesterday closed down at 1.29. So this has been uh, flattening somewhat aggressively in recent months. And, some gold bugs will get excited about that. But if you look at the last two bear markets and recessions, I mean, even after the flattening went to 1.0 and below, which of course, I mean, that's a signal of a recession. If you look at history, in the last two cycles, I mean, there can be a lag from when the curve inverts, and then you have a peak in the bull market, and then you have an eventual recession. So I mean, even though this looks like it's probably going to get to 1.0 fairly soon, if current trends continue, that doesn't necessarily mean we're going to have like a recession immediately or a bear market immediately. But to get back to the individual yields, with respect to gold, again, Corey, since all yields are rising, then in that kind of environment, for gold to do well, you need to see longer term yields rising faster than the shorter term yields. So that's why we look at the 10 and 2-year yield. But to start with longer term yields, Corey, if we look at the 10-year yield, I mean, that closed at 2.36% yesterday, but it really hasn't moved much in the last month or so. And if you go back to the beginning of the year, I mean, there is resistance around 2.60. So the 10-year is still a quarter point away from a massive breakout. However, if we look at the 5-year yield, now yesterday we noticed we were looking at these charts, it just closed by a hair at the highest level since 2011. That's 7 years. So this thing has really surged in the last couple of months, and it's broken above its resistance this year, reached a 7-year high. The 2-year yield has been absolutely screaming higher in the last couple months. Yesterday it closed at 1.83, and if we look at the Fed funds rate, Corey, right now we're in between, I should say, 1% and 1.25%. The 2-year yield, which is a proxy for the Fed funds, that's at 1.83%. So that's even on the high end, because we are going to, well, I should say, when we do hike in December, when the Fed hikes, their range will go from 125 to 150. The 2-year's at 1.83. So the 2-year has already more than priced in the December hike. It's already pricing in the March hike. So the market is way ahead of where the Fed is right now. So the Fed is going to have to catch up. Again, December is already priced in. March is being priced in as we speak. And unfortunately, these shorter term yields are rising much faster than longer term yields. And that's not bullish for precious metals. You mentioned real interest rates. If you look at the data on the U.S. Treasury's website, they calculate various real interest rates from the TIPS market. And the real 5-year yield, which in September, when gold got up to 1362, that was only at 1 basis point. That is now increased to yesterday to 46 basis points. So I mean that's nearly half a percent rise in the last couple months. So real interest rates are rising, and the yield curve, of course, is flattening. Those things are not bullish for precious metals. And unfortunately, when we look at the technicals of gold and gold stocks, Corey, we're kind of in gold not yet, but gold stocks, we're in breakdown mode. As we said, silver in breakdown mode. Gold and foreign currencies is weak. Gold against the stock market is also weak. So it's a negative situation right now. The market's clearly getting oversold, but it's fundamentally and technically, it's a negative situation, unfortunately.
Now let's focus on some of these charts, especially GDX right now, because yes, it is breaking down, but it still has just a little bit of room to go before it has, we would think, this support at the level right around 21, where GDX has bottomed actually 3 times this year. How worried are you, Jordan, that this sell-off continues and that we're not able to bottom right around 21 on GDX for a 4th time this year?
To answer your question, I would say I'm very worried. Looking at the technicals, I mean, we have a clear breakdown this week on the weekly chart. And, GDX has about 3% to go down to that 21 level you noted. I would look for probably a token bounce at that point, just because we've already bounced from there 3 times. But I mean, it looks to me like it would probably be a temporary low. I still think, given the negative fundamentals that we see right now, and given that, I mean, gold hasn't even broken 1260 yet, although I think it's very likely in the next couple days. It's just unfortunately, Corey, we've kind of just begun this breakdown, and there's just unfortunately there's a lot more downside to go. I mean, we're clearly oversold, but as you said, we're not very oversold yet. So when you're in a weak market and you're cracking and breaking down, you really want to see a very oversold condition. You just don't want to assume, well, I can buy in right now because things are oversold. You really want to see that condition get really stretched. And I don't see that happening, Corey, until GDX breaks below 21 and kind of gets into that territory. And that would be the time when I would be more optimistic that we're nearing, a real significant potential low. But 21, we'll probably hit that soon, and we'll probably bounce. But that's what I would call it. I would say it's a bounce and nothing more. Unfortunately, I mean, I know I keep saying that word, unfortunately, but it's just that this market has also been it's been moving slow. Although volume this week has been picking up, if you look at the daily volume levels. But yes, I mean, $21, it looks like we're going to test that. We'll probably bounce from there, but I'm not real optimistic at this point that that's going to be a lasting bottom. I think that's more likely to happen around the December low there, around $18.
Okay, Jordan, there's another aspect that I want you to address, and we haven't really chatted about this, but it involves the larger mining companies. I actually have a chart of Gold Corp up here, and usually when we are in a more of a bull market, or at least they turn into a more productive market, we see the big miners start to perform better. It's the smart money that enters the sector early. You look at Gold Corp, though, it's breaking to a new low for this year. To me, that is not very confident. That doesn't provide me a whole lot of confidence in terms of a near-term sustainable bounce back. What are your comments when we see a chart like Gold Corp already breaking down to new lows for the year?
You're pulling up Gold Corp. I mean, my comments on that, it's just not, I mean, it's not a good sign. That's really an ugly chart because over the last 18 months, 20 months or so. It's just that the Gold Corp has been consolidating at higher levels, but it's just been kind of grinding its way lower. And it just, I mean, that the chart is really negative. That actually looks like a good short to me. But yeah, I mean, that is not bullish for the sector. I mean, if you look at, there's an index where I think it's called the Dow Jones U.S. Gold Mining Index, and I'm not sure what the components are, but I know Gold Corp, Barrick, and Newmont are a pretty high percentage of that. Now that's a little stronger. I'm not sure why, but when you see one of the real big dogs like Gold Corp that's that weak, it's just it's not a good sign. I mean, it's not comforting. It's going to drag down these indices. I mean, if you look at Barrick, that's already broken below its 2016 levels, or the December low, I mean. So Gold Corp and Barrick, I can throw that in there with what you're talking about. Those are two that have, I mean, they're leading the sector to the downside. I know Newmont is much, much stronger than these two, but these are still two of the big dogs, and they've already broken below their December 2016 lows, which for GDX, I mean, we're talking about 18, in the $18 range. Gold Corp and Barrick, again, they're trading below that level already. And if you look at the sector is trading well above that level here and now. I mean, we're in the mid 21s. That support is around 18, mid 18s. Again, Barrick and Gold Corp are trading below that corresponding level. They've broken below it. So those are real ugly charts for the sector. And I guess we need to see those two. Probably we need to see a lot more selling there. We need to see them get bombed out, and that would move the sector to more of a extreme oversold condition and not just a token oversold condition like where we are here and now. So that's a very good insight on your part, Corey. Two of these big dogs the way they look right now, unfortunately, well, I shouldn't say big dogs, I should say big miners, but they but they do look like dogs right now. The way their charts are trading and the fact that they've broken below their December 2016 lows. But yeah, it's a great point by you, Corey. It just it's very negative for the sector. We need to see these things go potentially a lot lower before we can make that next bottom in the sector.
Yes, yes, we do. And unfortunately, this is just one of those things that the metals are under some pressure, and the big stocks, when they're under that pressure as well, it is a bit concerning. Again, I think that we can be encouraged that they're still well above their 2015 lows, but again, kind of as you said there, Jordan, 2017 not turning out to be all that productive for the metals. So let's see what 2018 holds, but man, I hope that they can almost just grind it out for the rest of this year and hope to get some more fundamental and even more technically positive outlooks, hopefully sooner rather than later. But right now, as always, it's great hearing what you have to say, even if, you know what, it is negative. Thanks for your time, Jordan.